This week we're going to be covering what does the budget mean for landlords and investors potentially. There's a lot of concern about it. A lot of people, saying I'm going to wait until after the budget. Again, is it really that important? Would it really affect the average person in the street? We frankly don't think so. And looking at historically, it hasn't really done so. So what is the budget going to mean? Potential rises the capital gains tax, more pain for landlords, increases in stamp duty, more pain for expatriate landlords. And then the third topic this week is, have interest rates been cut too quickly? So controversial. Obviously, Rachel Reeves needs to raise 22 billion apparently, and she's struggling to do so. Treasury officials hope to raise about $1 billion by reforming the UK's non-domicile regime, but now reassessing these plans because it could actually cost the taxpayer $1 billion in 2027, 2028 as wealthy individuals actually leave, and we've seen a lot of that. The problem is with any tax law is, tax law is like a rubber sheet, is that if you have a hole in it and you stretch the sheet to cover that hole, to get rid of it, another hole appears behind it, because that is tax law. It is just, there's always something that's going to come up. If you get rid of one hole, another one will always be created. And that's loopholes, but also problems with the loss of tax. So that is the thing with the Chancellor hasn't been able to use non-DOMs. So now she's turning her attention to raising the higher rate of capital gains tax. This was reported in The Guardian last week. The OBR is assessing how much money could be generated from a range of between 33 and 39% CGT on assets, including second homes. How high the government can push CGT rates again before assets are offloaded or owners opt to put them on hold waiting for a new government is a big thing. Recent Treasury analysis reported by the FT found that every 1 percentage point would raise 110 million 2027. An increase of 5 percentage points would actually result in a loss of 140 million. So again, it's the same thing. When you increase taxes, people change their behaviour. A 10 percentage point increase would lead to a loss in capital gains tax revenue of 2 billion. So it's chicken and egg. What do you do? So what exactly is capital gains tax? Just to clarify that, it's a charge that's triggered, and I'll read this out to make sure I get it correctly. It's a charge that is triggered when an asset is sold for profit. It's paid at different rates depending on your selling and the amount you earn. There's one rate for selling property, except your main home, which is exempt, and another for other assets. The basic rate taxpayer pays 10% capital gains on tax on assets and 18% on property, while a higher rate taxpayer would pay 20% on assets and 28% on property. You can take a profit of 12,300 in any 1 year before it kicks in. So will they increase capital gains tax? The fact that it's focused on second homes and wealthier people, I think there's every chance capital gains tax will go up. It'll be persecuting landlords and wealthier citizens again. So that's not great. Second thing they're looking at, as I mentioned, is stamp duty. Property prices are starting to go up again. So they're looking at what they can do. At the moment, there's a temporary cut in stamp duty, which is basically was put in place. It was reduced from 250,000 to 125,000, so on and so forth. Currently, you have a very steep raise. It goes from 5% at 250 to 925, and then 10% from 925 to 1.5 million, and then 12% above that. They're talking about increasing those steps and making them a lot higher. But one thing that will happen for expatriates is that, and this was recorded in Accountancy Daily this week, for offshore owners of UK property, Labour plans a minimum of 1% increase on the current higher rate, and that will raise in its own right at least 40 million per 1%. The current rate as an expatriate or a non-resident, and it'll be based on where you live. So being on this business of, well, I live in the UK, if you're tax resident in Hong Kong or Singapore, you will be taxed at the higher rate for stamp duty. So it's currently 2%. There's every chance it go to 3% and may even go to 4%. So that's raising stamp duty, which again is persecuting landlords, persecuting people who want to invest in the UK property market, and it will mean that the rental market will suffer because there'll be less properties out there for people to rent. Now, interest rates, loath I am to say it, but have they been cut too aggressively? The housing market continues to pick up, although it is quite slow. The September RICS residential market survey showed measures of demand, sales and listings all on an upward trend. The metric for house prices turned positive with a net balance of plus 11% and is now consistent with house prices rising at a national level. Therefore, the end of negative or flat returns in some areas is now nationally going upwards. So that's very positive. But unfortunately, what's happened is that in the race for lenders to get a piece of that market, they've cut their rates very aggressively, and consequently the margins now are extraordinarily thin, and perhaps too thin for the lenders to maintain. They were expecting an interest rate cut at the last budget. It didn't happen. They're expecting one at the next one. If that doesn't happen, then rates will start to rise again, which will potentially have a negative effect on the UK property market because, as I always say, sentiment is positive and it is going up the market because people are positive. Let's go out and buy. Even though you've got the budget coming up, which you've seen some people say, well, I don't know what I'll do. So if interest rates are not cut and rates do go up, and then we have an oil squeeze coming from the Middle East because of what's going on in Israel and Gaza, then there'll be a number of factors at play. One is the government wants to stimulate the economy so we don't get into go into recession. At the same time, they want to make sure we don't get inflation coming back again. So the problem is what can they do? And really, it'll be back to sort of more of a panic mode like we had in COVID when interest rates are just cut for the sake of growth. And I think that is a real reality. I don't think that we'll be seeing interest rates not cut going forward because the economy needs to be stimulated from an oil shock perspective, but also from a general, we need the economy to grow. And it is doing well at the moment. It's just on the G7 countries. I think it's third behind Germany and third behind the US and Japan. So it's doing very well at the moment. Long may it continue. So that's a market wrap for this week. Thanks for watching or listening if you're doing it on the podcast. Basically, the outcome is the budget will be not that great for property investors in that capital gains tax will go up, and for sure, I believe, and also stamp duty will definitely go up. What does that mean? Well, capital gains tax is actually quite a positive tax in some ways because it means you've made money. Okay, we don't like to pay tax, but we've all got a duty to do so. At the same time, you could always buy through an SPV, and if you buy through an SPV, then it's not a property sale to the purchaser, it's a share sale, so there can be tax benefits on that. Stamp duty, it's an easy target, expatriates, foreign buyers, and they will levy that at a higher rate. Thank you very much for listening. I hope you enjoyed it. Please do contact us at the email below if you'd like to ask any questions or if you'd like some input on any of your own situations or problems. We're very happy to give advice, and no advice is free in life, of course, but please do get in contact and let's have a chat. Thank you.